If you watch this video until the end, you'll finally understand whether Bitcoin sitting below $100,000 right now is a massive opportunity or a danger signal. Many wonder if this is the moment everything flips or the calm before a storm that wipes out investors buying the dip. The data behind this price level sends two completely different signals, one pointing toward the next massive leg up and another to a danger zone that has preceded every major crash. Until you know which signal actually matters, every decision you make, buying, selling, or holding, could be completely wrong for your long-term goals. Stay with me, because the real answer isn't what the bulls or the doom callers are shouting right now, and it could change how you invest for the rest of this cycle. Bitcoin is currently trading around the $90,000 to $94,000 range, generating intense debate among investors. The Crypto Fear and Greed Index stands at 28, reflecting a fearful market sentiment. On one hand, Bitcoin ETFs recently saw a net inflow of $240 million, breaking a 6-day streak of losses, indicating buying activity. However, on the other hand, some analysts point to Bitcoin ETF outflows as a concern, and future CVD remains negative. Historically, Bitcoin's price is often analyzed in relation to its halving events, which occur approximately every 4 years. Past cycles show multiple instances where Bitcoin retraced 20% to 40% or more before resuming an upward trajectory. For example, the 2018 crypto winter saw a substantial percentage drop, yet it was followed by a strong continuation to new highs. A break below the $94,000 to $95,000 support zone could lead to a drop towards $60,000 to $80,000. Losing the $100,000 level could trigger a sharp move toward $92,000 to close a CME gap, a pattern Bitcoin has a history of filling. However, if Bitcoin holds the multi-year support zone, the long-term bull case remains intact. Ultimately, clear risk management, attention to derivatives positioning, and a multi-horizon perspective are crucial for navigating these volatile markets.
Most investors are asking the wrong question right now. Bitcoin just fell below $100,000, the lowest level in months, and social media instantly exploded with predictions. But here's the truth. None of that matters if you don't understand what this drop actually means. Because every sharp Bitcoin move isn't just about crypto. It's a reflection of global risk appetite, interest rates, macro pressure, and investor psychology. So today, we're not here to guess the future. We're here to answer the only question that matters. Is Bitcoin under 100K a buying opportunity or a massive red flag that most people are ignoring? Stay with me. You'll understand exactly what this move really means for your money.
Bitcoin's recent drop wasn't an isolated event. It was part of a much broader market reaction. This significant move coincided with U.S. stocks opening lower, a widespread sell-off in risk assets, and a surge in volatility. It wasn't just a crypto crash, but rather a global risk-off event, driven by uncertainties like geopolitical tensions and economic slowdowns. Think of financial markets like a thermostat. When uncertainty rises, investors instinctively dial down their exposure to risk. This means money moves out of assets like Bitcoin, tech stocks, growth ETFs, and emerging markets. Conversely, funds are reallocated into safer havens such as treasuries, money market funds, and defensive ETFs. Bitcoin's correlation with tech stocks and growth ETFs means it often experiences similar sell-offs during uncertain times. Institutional investors, now a significant force in the Bitcoin market, often treat it similarly to tech stocks, especially after the approval of Bitcoin ETFs. Macroeconomic conditions like interest rates, inflation, and Federal Reserve policies heavily influence these synchronized trading patterns. While some view Bitcoin as digital gold, its behavior often aligns more with a risk-on asset, challenging its safe haven status. Events like government shutdowns, trade wars, and tariff announcements can further intensify market volatility, impacting Bitcoin's price. Treasury yields also play a crucial role, often rising with inflation but selling off when market volatility jumps due to debt concerns or potential tariffs. Ultimately, Bitcoin dropping below $100,000 is simply the most dramatic symbol of this broader, global shift in investor sentiment.
To understand whether Bitcoin under 100K is an opportunity or a warning signal, you need to understand why Bitcoin moves more violently than almost any other major asset in the world. There are 4 forces behind every dramatic Bitcoin move. 1. Bitcoin behaves like a high beta tech stock. When markets are optimistic, Bitcoin rises faster than almost anything else. But when markets turn fearful, Bitcoin doesn't just fall, it amplifies the fear. It reacts to macro sentiment with more intensity than growth stocks, because it lives on the edge of risk appetite. 2. Interest rates directly affect Bitcoin's appeal. Bitcoin doesn't generate earnings. It doesn't produce cash flow. So when interest rates rise and safer assets start offering higher returns, investors demand more upside to justify holding Bitcoin. Higher yields equals lower appetite for pure risk assets. That's why Bitcoin often weakens when treasury yields climb. 3. Leverage accelerates every move. Crypto isn't traded with small leverage. You see traders using 10x, 20x, sometimes even 50x positions. So when Bitcoin drops just 2% or 3%, heavily leveraged traders get margin calls, forced liquidations, cascading sell-offs, and rapid downward spikes. That's why Bitcoin can fall far faster than traditional assets. It's not just selling, it's forced selling. 4. Bitcoin is narrative-driven. Crypto moves on emotion more than almost any other asset class. When narrative is positive, institutional adoption, having cycles, rate cut expectations, the price surges. But when narrative flips, fear spreads instantly, and price reacts before fundamentals even change. Put these 4 forces together: high beta, interest rate sensitivity, massive leverage, and emotional narratives, and you get an asset that magnifies every macro shift and every sentiment change. This is why Bitcoin can drop below 100K without anything fundamentally breaking. It's reacting to the environment, not collapsing on its own. When Bitcoin breaks below a major level like $100,000, the move isn't just mathematical, it's psychological. Because there are 2 types of declines. If Bitcoin falls gradually, that's a normal correction. Markets breathe, cool off, reset. But when Bitcoin breaks a major psychological anchor, something very different happens. Fear accelerates. $100,000 is not just a price. It's a symbol. When Bitcoin crosses under it, investors begin thinking, is the trend reversing? Is something bigger happening? Should I sell before it gets worse? These questions trigger emotional reactions far faster than rational ones. Most investors don't sell because of numbers. They sell because of meaning. And here's the twist. Breaking a psychological level does not automatically mean Bitcoin's fundamentals changed. Sometimes, it simply means investors hit their emotional threshold. Think about it. Bitcoin didn't break $100,000 because its technology collapsed, or because adoption suddenly disappeared, or because long-term demand vanished. It broke because the macro environment tightened, risk appetite fell, leverage positions were unwound, fear took control. In markets, fear always moves faster than fundamentals. So what does falling below $100,000 actually mean? It means the crowd is reacting emotionally. It means leverage is being flushed. It means expectations are adjusting. But it does not answer the real question. Did something fundamentally break? That is the question you must evaluate before deciding whether this is a buying opportunity or a warning sign. In the next section, we'll look at the macro environment, because that's where the real answer begins. Bitcoin isn't just reacting to crypto news, it reacts to macro pressure. Because when you zoom out, it becomes clear Bitcoin is one of the purest expressions of global risk appetite. So let's break down what the macro environment actually looks like right now. First, interest rates are still high. High rates make borrowing more expensive, tighten liquidity, and push investors away from risk assets. Bitcoin doesn't produce cash flow, so when yields rise, its relative appeal falls. It's not personal, it's math. Second, rate cut expectations have weakened. Markets were expecting the Federal Reserve to cut rates more aggressively, but the Fed has signaled caution. Slower cuts mean less liquidity, and less liquidity means lower appetite for risk. Historically, when rate cut expectations weaken, Bitcoin weakens with them. Third, stocks are volatile. Traditional equities are struggling to find direction, and remember, Bitcoin follows risk assets, not the other way around. When stocks wobble, crypto shakes harder. Fourth, global uncertainty is rising. Geopolitical tensions, elections, corporate layoffs, inflation risks, and mixed economic data all contribute. All of this pushes investors towards safer assets. Uncertainty equals defensive positioning, and defensive positioning equals lower Bitcoin demand. Fifth, the dollar is strengthening. A rising US dollar puts pressure on global assets, including commodities like gold and oil, and Bitcoin behaves similarly. When the dollar strengthens, Bitcoin often loses steam. So what does all of this mean? Bitcoin falling under $100,000 is not random, and it's not a sign of collapse. It's the logical reaction to a macro environment that is temporarily unfriendly to high-risk assets. Long-term fundamentals didn't disappear, but the short-term environment has become heavier, tighter, and more cautious. And the smartest investors never ignore the macro landscape. They use it to understand why prices move and what the environment is rewarding right now.
Before you buy any dip, whether it's Bitcoin or another asset, you need a clear framework to guide your decisions. It's crucial to rely on logic, not emotion or hype, when evaluating investment opportunities. Smart investors never buy dips blindly. Instead, they carefully evaluate 3 fundamental pillars before taking any action. Let's break down these critical pillars clearly, providing you with a practical, educational framework. Pillar 1 is your time horizon, which significantly impacts how Bitcoin behaves. If your investment horizon is 0 to 12 months, Bitcoin is extremely volatile, and short-term moves can go against you fast and hard. For a 3 to 5 year horizon, market cycles become more important than daily fluctuations, making dips more predictable and historically meaningful. With a 10+ year horizon, deep pullbacks have historically presented opportunities, but only if you maintain consistency and emotional discipline. Ultimately, your chosen time horizon is the defining factor for your investment strategy. Pillar 2 focuses on allocation size, a critical aspect of risk management. Never go all in, not in crypto, and certainly not in any other investment. Professional investors typically allocate no more than 1% to 5% of their total portfolio to Bitcoin or other crypto assets. Ask yourself one crucial question. If Bitcoin went to 0 tomorrow, would my financial life survive? If your answer is yes, then your allocation is safe and well managed. However, if your answer is no, you are likely overexposed and trading emotionally, not strategically. Remember, allocation is not about confidence in an asset. It's fundamentally about protecting your overall financial well-being. Pillar 3 involves understanding risk signals, which are vital before touching any dip. First, examine funding rates. Are traders still over-leveraged? If so, more liquidations may be imminent. Next, assess market sentiment. Avoid extreme greed, but accumulate slowly and carefully during extreme fear. Finally, consider the macro trend. Rising rates often lead to falling risk assets, while Fed signals of cuts usually bring a return of risk appetite. These 3 signals are crucial for distinguishing between a healthy investment opportunity and a dangerous falling knife. The purpose of this framework is not to tell you what to buy, but rather how to think. It empowers you to avoid being trapped by emotion, hype, or panic in volatile markets. Because in volatile moments like these, logic consistently beats excitement. Discipline triumphs over adrenaline, and clarity always prevails over noise. By applying this framework, you can make more informed and strategic investment decisions.
When Bitcoin drops below a major level like $100,000, there are only 2 scenarios that matter: the opportunity scenario and the red flag scenario. Let's break them down clearly and calmly. This is what it looks like when a dip becomes a long-term opportunity. The Federal Reserve moves toward rate cuts, and liquidity improves across financial markets. Stock volatility cools, leverage unwinds and stabilizes, and fear begins to fade. Bitcoin quickly reclaims $100,000, and long-term fundamentals remain untouched. In this environment, history shows that deep pullbacks often became stepping stones to the next bull cycle. This is not hype. It's simply how risk assets behave when macro conditions improve. Now, let's consider the red flag scenario, when caution is wiser. The macro environment worsens, and the Fed delays cuts longer than expected. the US dollar strengthens further, stock market volatility increases, and more liquidations hit crypto platforms. Bitcoin fails to hold key supports, dropping from $95,000 to $92,000, then $88,000, and potentially lower levels. In this environment, waiting is not fear, it's discipline. Short-term pain can continue until macro pressure eases and liquidity returns. So which scenario is happening now? Neither is guaranteed. That's the point. Your goal isn't to predict the exact path. Your goal is to recognize the environment and position yourself in a way that survives both possibilities. Because smart investors don't chase certainty, they prepare for reality. And reality always gives you two paths, opportunity or caution. Understanding the difference is how you avoid emotional mistakes and make strategic decisions that last longer than a single headline.
I'm not here to predict the next candlestick. No one can. But here's what the data and history consistently show. Bitcoin falling below $100,000 is not a sign of Bitcoin failing. It's a sign of fear, tight macro conditions, and a temporary shift in risk appetite. And fear does something powerful. It creates opportunity for disciplined investors and danger for emotional ones. Short-term traders feel panic. Long-term investors see cycles. And beginners? They often confuse noise with signal. But here's the truth smart investors understand. Volatility is the price of long-term upside. Emotions are the price of short-term mistakes. Bitcoin's fundamentals didn't disappear. Adoption didn't collapse. Institutional interest didn't evaporate. The technology didn't change. What changed was sentiment. What changed was the environment. What changed was the mood. And mood always swings faster than fundamentals. So if you're short-term, be cautious. If you're long-term, stay structured. If you're new, start small, think clearly, diversify wisely. Because no dip is automatically a buying opportunity, but no correction is automatically a danger either. The difference is how you manage risk, how you understand cycles, and how you position yourself for the long game. If today's video helped bring clarity to all the noise surrounding this drop, hit like so more people can find it. And subscribe for the next deep dive, where we'll break down how long-term investors build balanced strategies even in high volatility markets like this. Before you go, tell me in the comments, do you think Bitcoin recovers from here, or do we head lower first? I'd love to hear your take. See you in the next one.